Somewhere in the global financial system, there's a fuse already burning. You can't see it on the news. You won't find it in public reports, but it's there, buried inside contracts so complex, even their creators barely understand them. Contracts worth over $1 quadrillion. They call them derivatives. Born as tools to manage risk, they became the sharpest blades in finance, and sometimes the most unstable explosives. In 2008, one of these contracts almost took down the world economy. The explosion was contained, barely, but the same bomb is still ticking. Who holds it now? Who decides when or if it goes off? Today, we follow the fuse to its source, and what we find may change how you see the system forever.
The market you know is a performance. Screens glow, numbers tick, and the crowd reacts. Stocks climb, currencies slide, bonds shift hands, and you think you're seeing the whole play. But the spotlight only shows what you're meant to see. Behind the curtain, there is another stage, a silent stage, where the stakes are far higher and the consequences far deadlier. This is the derivatives market. Most people have never heard of it. Those who have rarely understand it, yet it dictates the fate of entire economies. It doesn't move billions, it moves trillions every single day, without headlines, without noise, like an underground current strong enough to drag the world into the depths. Picture this. In a glass tower, two bankers exchange a digital contract. No cash changes hands, no stock certificates, just lines of code and a handshake. One promises to pay if interest rates rise, the other if they fall. To an outsider, it looks harmless, routine, safe. But overnight, that single contract can mutate into a billion-dollar liability. Now multiply this by millions. Contracts layered like a web, linking banks, hedge funds, insurance companies, even governments. Each thread is thin, but together they form a net so vast it wraps around the global economy. The total value? Over $1 quadrillion, a number so staggering it dwarfs the GDP of every country combined. How did it grow this large? Because these deals don't trade on open exchanges where you could see them. They happen in private, over the counter, in back rooms and encrypted calls. No order book, no public record, no real oversight. They were born as shields to hedge risk, but greed reshaped them into weapons, and weapons in the wrong hands do not stay silent forever. Think of each derivative as a tripwire. Alone, it's harmless, but when they're connected, when one wire snaps, the shock doesn't stay in one place. It races across the system, setting off more triggers, like a chain of explosives hidden under the floorboards of the global economy. This isn't theory. It's happened before. In 1994, a single U.S. county, Orange County, California, went bankrupt because of derivative bets gone wrong. In 1998, Long-Term Capital Management, a hedge fund run by Nobel Prize winners, collapsed so fast it threatened the entire financial system. Both were contained, barely, but each incident was a warning. The fuse is real, and it burns faster than anyone expects. Regulators? They try to watch, they try to measure the risk, but they admit the truth. The market is too big, too complex, too opaque. Even the banks themselves often don't know the full exposure buried in their books. They're playing with fire, blindfolded, convinced they can control the flames. Meanwhile, ordinary people, you, me, everyone, live inside the blast radius. Our pensions, mortgages, savings, all are tied to bets we never agreed to. Most don't even know the room is full of explosives. They go on with their lives, unaware that one spark could erase decades of work in seconds. And here is where the tension rises. Someone holds these wires. A few institutions have the power to pull strings or cut them. They operate in silence because silence protects them. They profit while the rest of the world stands on edge, not even realizing it. But cracks always appear. The wrong move, the wrong shock, the wrong moment, and the system begins to shake. It happened in 2008. It can happen again. Before we push deeper, hit the like button. Not because it's routine, but because this story is one they prefer to keep hidden. The more people know, the harder it is to bury the truth. The fuse is burning, the pressure is rising, and soon you'll see the faces behind the detonator, the hidden hands that could bring the world to its knees.
You've seen the bomb. Now it's time to meet the ones holding the wires. The derivatives market is not a place for the many. It's a fortress accessible only to the few, the giants of finance who move through its corridors unseen. To the outside world, they look like banks, funds, and insurance companies. But inside this market, there's something else entirely. Power brokers who can tilt the global balance with a single move. Start with the banks. JP Morgan Chase, Goldman Sachs, Deutsche Bank. Names that sound familiar, almost ordinary. Yet they sit at the center of a web so complex that even governments rely on them. These institutions control hundreds of billions in derivatives positions, sometimes more than their own capital. They use these contracts to hedge, yes, but also to speculate on everything. Interest rates, credit defaults, even the weather. Then there are the shadow players, hedge funds. Unlike banks, they answer to no one but their investors. They thrive on risk, using leverage to amplify bets into unimaginable sizes. Funds like these helped ignite past crises, profiting as the world burned. Their weapons? The same contracts buried deep in this market. And don't forget insurance giants. They step in as the ultimate backstop, selling protection to banks and funds who want to feel safe. But as 2008 proved, that protection is only an illusion. When the bets go wrong, the insurer becomes the spark that lights the explosion. That's exactly what happened with AIG when its credit default swaps, once sold as safe, nearly brought down the entire system. These players don't operate in daylight. They meet behind closed doors, in conference rooms where phones are locked away and cameras forbidden. They negotiate terms so complex only a handful of people in the world understand them. And they do it knowing the risk doesn't stay with them, it spreads. You might think regulators keep them in check. They try. They issue rules, demand reports, hold meetings. But the truth is, the market moves faster than the rules. The players innovate, disguise, restructure. By the time regulators catch up, the game has already changed. And this secrecy isn't accidental. It's a shield, because the less you know, the more control they have. Consider this. In public, they talk about risk management and financial stability, but behind the curtain, they trade risk like poker chips. They know the stakes. They know the system is fragile. Yet they keep betting because the profits are too big to resist, and because when things go wrong, someone else pays the price. Who are these players really loyal to? Their shareholders? Their clients? Or the game itself? In the shadows, these players are connected by contracts no one fully sees. And when one of them miscalculates, the shock doesn't stop at their door. It travels everywhere. In 2008, it almost brought the world to its knees. And the same fuse they lit back then is still burning. The next step of this investigation, tracing that fuse back to the moment when it almost detonated, the moment the world held its breath. The fuse had been burning for years, hidden beneath the noise of a booming market. Credit was cheap, houses were selling like lottery tickets, and Wall Street was drunk on its own success. From the outside, the system looked invincible. Inside, the explosives were being stacked higher, tighter, deadlier. The year was 2008. Officially, the economy was thriving. Unofficially, banks were sitting on mountains of mortgage-backed securities, bundles of home loans sold as safe investments. But many of those loans were toxic, given to borrowers who could never repay. To cover themselves, the banks turned to a special kind of derivative, credit default swaps, CDS. A CDS is simple on the surface. It's insurance. If the loan goes bad, the seller of the swap pays the loss. Banks bought billions of these contracts, convinced they had hedged their risks. The largest seller? AIG, an insurance titan with a reputation for stability. For years, AIG wrote swaps on mortgage securities without keeping enough cash to back them. Why would they? Defaults were rare. The premiums flowed in. It was easy money, until it wasn't. When U.S. housing prices began to fall, cracks spread through the system. Homeowners defaulted, foreclosures surged, and those safe mortgage securities lost value overnight. Every default lit another fuse. Every downgrade sent shockwaves across the derivatives web. Suddenly, AIG's promises became deadly liabilities. The company was on the hook for hundreds of billions in payouts it didn't have. Margin calls poured in, demanding collateral AIG couldn't provide. The market sensed blood. Banks that had counted on AIG's protection now faced catastrophic losses. The web was tightening, and there was no way out. This was the moment of panic. The contracts were designed to transfer risk, but instead they multiplied it, bouncing it back and forth through a network that connected every major institution. The failure of one node threatened to pull down the entire structure. Inside government war rooms, the mood turned to fear. Officials realized that if AIG collapsed, the shock wouldn't stop there. It would rip through Wall Street, through Europe, through every country tied to U.S. credit markets. Banks would fall one by one, hedge funds would evaporate, and ordinary citizens, far removed from these contracts, would pay the price in lost jobs, lost homes, lost futures. The only option was intervention. The U.S. government executed an unprecedented $182 billion bailout. Money was pumped in not to rescue AIG as a company, but to prevent the global system from imploding. Behind closed doors, leaders admitted the truth. They were no longer controlling events, they were trying to survive them. When the dust settled, the world saw the cost. Millions lost their homes, their savings, their faith in the system. Yet the players who caused the crisis were still standing. AIG survived, banks recovered, bonuses returned. The very structure that almost collapsed the world remained intact. The 2008 crash revealed a brutal reality. Derivatives didn't just spread risk, they concentrated it, magnified it, and turned a housing downturn into a global catastrophe. The bomb had gone off, but the world was lucky. This time the system didn't fully break. And what happened after? Instead of dismantling the explosives, the market built new ones. Regulations went and went, but the core remained. The contracts continued. The market grew even larger. The fuse, though scorched, was relit. The world avoided destruction by a thread, but threads snap, and the fuse is still glowing, creeping silently toward the next ignition point. The question is no longer if the explosion will come. The question is who will be holding the detonator when it does. The world promised it had learned its lesson after 2008. Politicians swore the system would be reformed. Regulators claimed the risk would be contained. New rules were written, banks were stress-tested, and everyone said the next crisis was impossible. But behind the speeches, the game never stopped. The derivatives market didn't shrink, it expanded. Today, its notional value still exceeds $1 quadrillion, a number so massive it's almost meaningless. The contracts are more complex, the players more connected, and the stakes
far higher. How is that possible? Because derivatives remain the hidden fuel of the financial system. They're used to bet on interest rates, currencies, commodities, corporate debt, sovereign bonds, even weather events. These bets happen at a scale no exchange can monitor and no government can fully control. Every trade adds another thread to the web, and every thread is a potential fault line. In recent years, warnings have surfaced. European regulators have raised alarms about Deutsche Bank's massive derivative book. Hedge funds have collapsed under leveraged positions, like Archegos in 2021, sending shockwaves through markets. Even small tremors, a sudden spike in interest rates, an energy crisis, political instability, have triggered margin calls and liquidity shortages in places nobody expected. Each event is a reminder: the bomb is still wired into the system. And then there's the rise of shadow banking, institutions operating outside traditional regulation, quietly holding trillions in opaque derivative positions. They are the wild cards. When pressure builds, they have no safety net. Their collapse would ripple instantly across borders. Technology has made the market even faster. Algorithms trade derivatives in microseconds, amplifying swings at speeds human oversight can't match. One wrong calculation, one glitch, and billions can vanish in the blink of an eye. Central banks like to believe they have control. They print money, adjust rates, and promise stability. But in reality, they're playing catch-up. The derivatives market is too big, too fast, and too interconnected for anyone to fully understand. Even the players themselves admit they don't see the whole picture. For the public, the danger is invisible. Markets go up, portfolios grow, confidence returns. But under that surface, the same explosives that almost detonated in 2008 are still there. Only now there are more of them, wired together in ways nobody fully maps. The fuse is still lit. It winds through banks, funds, and shadow institutions, glowing faintly under the surface of the global economy. Every unexpected shock, a failed institution, a geopolitical crisis, a sudden spike in rates, sends the spark racing faster. And when it reaches the wrong point, no bailout may be big enough to contain the blast. The bomb that once nearly destroyed the system was not dismantled. It was rebuilt, bigger, quieter, and deadlier. The only question that matters now, when it goes off, who will be holding the wire? And who will pay the price?
You've seen the hidden market. You've met the players behind the curtain. You've watched how one spark almost destroyed the system and how the bomb was rebuilt, stronger than before. The derivatives market is not a relic of 2008. It is alive, expanding, waiting. Contracts worth over $1 quadrillion still tie the world together with invisible threads of risk. Every deal, every hedge, every hidden bet adds more weight to the structure. Most people will never see it. They will live their lives inside the blast radius, unaware that their pensions, savings, and jobs are tethered to a system designed to look safe while hiding chaos beneath. The fuse hasn't stopped burning. The question is not if it will reach the explosives, but when. And when it does, the shock won't stay confined to Wall Street. It will travel everywhere. If you want more investigations like this, hit the like button. Subscribe so you never miss the next revelation. The more people know, the harder it is for these secrets to stay buried. The game is still on. The bomb is still ticking. And now, you know where to look.